Hey folks, I'm David McKnight, author of The Power of Zero. If you've spent any time on YouTube, LinkedIn, or Instagram lately, you've probably stumbled across a wave of whole life insurance agents telling you that Indexed Universal Life Insurance, also known as IUL, is fatally flawed, that it's destined to collapse under its own weight, and that the only sane choice for cash value life insurance is, you guessed it, whole life. Well, today I'm going to show you why that narrative is dangerously misguided. So if you're wondering whether an IUL can really stand the test of time, or whether it's just a ticking time bomb waiting to explode, this video is for you. Whole life insurance salespeople love to trot out this familiar talking point. IULs will inevitably lapse in your 70s or 80s because the internal costs skyrocket and eat up the policy's cash value. Eventually, the whole thing collapses like a house of cards. And look, I get it. This type of inflammatory rhetoric can be pretty unsettling, especially if you currently own an IUL or are planning on getting one. But here's what these whole life insurance salesmen are not telling you. They're assuming that the IUL is improperly structured, underfunded, and never monitored. In other words, they're pointing to the worst case scenario and acting as if it's a foregone outcome for all IULs. But folks, if you structure an IUL properly, fund it appropriately, and manage it proactively over time, the policy doesn't just survive, it thrives. Yes, it's true that the cost per thousand of insurance increases as you age. That's just a function of actuarial math. You get older, your risk of death increases, and so the cost of insuring you goes up, but that's only part of the story. If your policy is structured correctly, the amount of insurance you're paying for over time actually goes down. Let me say that again because it's a crucial point. The amount of life insurance you're paying for as a function of your death benefit actually goes down as your cash value goes up. That means you're paying for less insurance over time, not more. So even though the cost per thousand is rising, the amount of insurance you're actually paying for is shrinking. As a result, your cost of insurance as a percentage of your cash value goes down dramatically over time. Here's an example to help illustrate. Let's say you start your IUL with a $1 million death benefit and no cash value. At first, the net amount at risk for the insurance company is the full $1 million. That's the amount of life insurance you're paying for. But as the cash value grows, let's say to $400,000, you're now only paying for $600,000 of life insurance. Your total death benefit is still $1 million, but the amount of actual life insurance is that $600,000. So yes, you're older, and yes, the cost of insurance is higher at that point in the policy, but you're paying for less of it. Okay, let's fast forward another 10 years, and let's say your cash value is now $700,000. Now the insurer is only on the hook for $300,000. So yes, while the cost per thousand of insurance is higher, you're paying for less of it. That's a huge point that whole life agents conveniently leave out. Now let's be fair, whole life insurance does have one advantage: predictability. You know more or less how your policy will perform, assuming you keep making those fixed premium payments for your entire life. But predictability comes at a hefty cost. Whole life has lower returns, higher loan interest rates, and less flexibility in how and when you fund the policy. If you're planning on using your cash value life insurance to build money up so that somewhere down the road you can take money out and spend it on your retirement in a tax-free way, then a properly structured IUL is the better tool for the job. You have higher growth potential, guaranteed 0% loans, assuming you're with the right carrier, and much more flexibility over the life of the program. And let's not forget, predictability in whole life is only valuable if you can stick with the policy. Miss a few premium payments and the whole thing can unravel. Here's what certain whole life agents don't want you to know. You can structure an IUL to minimize the insurance costs. In fact, we want to buy as little insurance as the IRS requires of us and stuff as much money into it as the IRS allows. We're basically trying to mimic all of the tax-free benefits of the Roth IRA without any of the limitations of the Roth IRA. You can actively manage an IUL. You can perform ongoing stress tests, monitor performance, and adjust premiums or death benefit levels over time. You can borrow from your IUL tax-free and cost-free, assuming once again that you're with the right carrier. Compare that to whole life, where the net cost of borrowing can be anywhere from 1% to 4%. Doesn't seem like a big deal, but that interest can really snowball over the life of the policy, bankrupting it far in advance of when you ever dreamed possible. This scenario comes into play particularly if you're using your whole life policy as a source of tax-free income in retirement. And yes, when done right, the average annual IUL expenses over the life of the policy can actually be lower than those in most 401k plans. I've broken these fees down in multiple videos on my channel, so feel free to go check them out. All of this assumes, of course, that you're working with a reputable carrier that conforms to all of the IUL attributes I specify in my best-selling book, Look Before You Lerp. Remember, not all IULs are created equal. When looking for the right IUL, you want a company with low fee structure, strong cap rates and participation rates, a good track record of honoring crediting strategies, and guaranteed 0% loan provisions. Remember, all loans from life insurance policies are tax-free, but they're not all cost-free. Insist on having them both. Pick the wrong carrier, and yes, things can go off the rails, but choose wisely and you have a vehicle that provides tax-free growth, tax-free distributions, and a death benefit that can double as long-term care. So here's the bottom line. Whole life insurance salespeople sometimes love to point fingers at IULs, calling them time bombs just waiting to explode. But what they fail to mention is that when you design the policy correctly, properly structured, properly funded with a top flight carrier, it becomes one of the most powerful tax-free retirement tools in your arsenal. No required minimum distributions, no income limitations, no contribution limits, and tax-free access before age 59 and a half. Now, are IULs flawless? Of course not, but what is flawed is a marketing approach that condemns a financial tool that, when executed properly, can be a powerful component in a balanced, comprehensive approach to tax-free retirement planning. If you want to know how to structure an IUL the right way with the lowest cost and maximum flexibility, head over to DaveMcKnight.com and click on the Connect with an Advisor button. I'm happy to connect you with an advisor in my Power of Zero network, been trained, vetted, and qualified personally by me. If you're a financial professional and wants to learn how to do this for your own clients, head over to PowerZero.com and check out my free 3-part video series. And if you've got any comments or questions, feel free to drop them into the comment section below. I do my very best to respond to every single one of them personally. And don't forget to click like, subscribe, and the bell so you never miss a video. This is David McKnight. Thanks for watching, and I'll see you on the next video.